trade, and tariffs continue to grab a lot of the macroeconomic headlines. And it will be interesting to see what the Bank of Canada does with interest rates on Wednesday the 12th in this context. But this should not be allowed to overshadow what continues to be an informative reporting season here in the UK. Positive surprises relative to forecasts and dividend increases continue to outweigh earnings downgrade and payment cuts, while the pace of share buyback announcements is running ahead of the same stage last year. Now, none of that might fit with the gloomy narrative that generally surrounds the UK economy and its stock market, and we may get some fresh insight from another busy week of half-year and full-year results. Names which may be worthy of further study include the following, although do note some of these dates could yet be subject to change. Clarkson on Monday the 10th, Spirax, Rotork, STV, Domino's Pizza and Costin on the 11th, Balfour Beatty, Hill & Smith, Forterra and Hochschild Mining on the 12th, Deliveroo, Restore, Savills, DFS Furniture and Volution on the 13th, and Vanquis Banking on Friday the 14th. But three names which may give us deeper insight to the UK economy, as well as the fortunes of their own businesses and their industry, are as follows. All are sensitive to interest rates for starters, and they are house builder Persimmon on Tuesday the 11th, life insurer Legal & General on the 12th, and Challenger Bank OSB on the 13th. To start with Persimmon, the York headquartered company shares are down by a sixth over the past year and by 2/3 from 2020's all-time high, thanks to the conclusion of the Help to Buy scheme, higher interest rates, higher input costs, cladding remediation expenses, lower consumer confidence, and, ultimately, lower completions and flatlining prices, which have in turn led to lower profits and dividends. For the share price to turn around and change in some of those trends would therefore be welcome, and analysts and shareholders will look forward to comments on all of them from Chief Executive Dean Finch, particularly with an eye on 2025. Persimmon's already given a pretty detailed update for 2024 back in January, so any guidance for the coming year may be the key, but in terms of the headline figures, completions last year rose 7% and prices by 5% to 10,664 homes and £268,000 respectively. With 2025 in mind, watch out for any comment on the new year trend in forward sales, £1.2 billion at the last count, and also the trend in sales per outlet per week, which averaged 0.7 in 2024, up from 0.58 in 2023. Then in terms of profits, pre-tax income is expected to reach £383 million, up by some 10%, and analysts expect a mid-teens percentage advance to £438 million for 2025. Helped by a net cash pile and higher income, Persimmon is expected to eke out a modest increase in its dividend in 2024 and 2025 compared to the 60p a share paid out in 2023. The FTSE Index member is not, however, running a share buyback scheme. Finally, watch out for any comment from Mr. Finch on cladding remediation costs. Persimmon took a £275 million provision here in 2022, but hasn't done much since, and even wrote back £23 million of that in the first half of last year. Meanwhile, shares in Legal & General are pretty flat over 1, 5 and 10 years. Chief Executive Antonio Simoes is trying to inject some momentum with his new strategic plan that was unveiled last June. Here, the focus is on pension risk transfers for workplace pension schemes, asset management and private pensions, and the company has already announced the sale of its UK house building and US insurance operations. These results will be viewed in the context of the medium-term goals out to 27 laid down by Mr. Simoes last summer, namely, compound annual earnings per share growth of between 6 and 9%, 5% dividend growth for 2024 and 2% a year thereafter, and then those payments contribute to a goal after the disposal to return £5 billion via dividends and buybacks to shareholders over 3 years. Now that is equivalent to more than a third of the current stock market capitalisation. Legal & General does look to have sufficient regulatory surplus capital to back up such plans already. OSB is another firm whose shares have been going sideways with no gains over the past year and a drop of a quarter from 2022's peak. That decline owes much to the sticky UK economic environment, as OSB specialises in buy-to-let, residential and commercial property mortgages, and a pair of profit warnings, ultimately in summer 23 and summer 24, have done that share price damage. The first warning was blamed on how mortgage consumers refinanced earlier than normal, the second on margin pressures thanks to competition in the mortgage market. Therefore, watch out for trends in loan and deposit growth, loan impairments, and the net interest margin in particular, which boss Andy Golding's already suggested will come in between 2.3 and 2.4% in 2024. All of those will help to shape pre-tax profits, where analysts expect a rebound after the refinancing hit to £424 million for the year just ended, but then there'll be a dip in 2025 to £395 million. As for the dividend, small increases are expected for 24 and 25 compared to the 32 pence a share paid in 2023. OSB is also running a £50 million share buyback programme. Hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you next time.